Is it overreaction to move exposures to the United States away from Europe because of political risk?
Yeah, well, look, I think we've got the same political risk in the US, don't we? Who knows what's going to happen later this year with, whether it's a Trump presidency or a Biden presidency. I mean, I think what we're seeing is just, it seems that everything is lurching to more, far right, extreme right. Whether that's because people have more of a view, whether it's because the constant cost of living is making people fall behind. But yeah, I mean, it seems to be a global theme, doesn't it, at the moment in the Western world?
The gains we saw on the market yesterday, well, I think we're scratching for answers whether it was money moving across from Europe to the United States or whether it was something else going on. But it really tests the theory that the markets need a rate cut soon to sustain momentum. We're still bouncing from record to record.
Well, I've been saying this for a while, obviously, and I've been completely wrong so far. But I think they do need to cut sooner than you think. I think the latent impact of rate increases takes a while to come through because of credit card costs, housing costs and the like. I mean, the risk obviously, and they were too slow to increase rates on the way into this inflationary spike. The risk on the other way down is much more significant. You cause a recession. So, I think obviously central banks have been bruised because they've been told that they were asleep at the wheel on the way into this inflationary spike. And that's probably leading to some sort of hesitancy to cut rates at the moment, I would suspect.
How do you cut when we've got a flash at the bottom of the screen? Wage inflation holding up in the UK and US. That's from your shop.
Yes.
I've just seen a headline yesterday that Haig Bathgate wants 7% in Germany. Mm-hmm. So 7% Germany, 6-ish% in the UK and US. How do you cut with that as a backdrop?
Yeah, I mean, this is the problem that they've got, isn't it? I mean, they're sort of, they're going to be criticised in either direction. I mean, I think the thing is that this wage growth is a sort of slightly lagging indicator. What we need to see is the jobs data slacken off, and I think the central banks have a lot more confidence to cut it at that point. But at some point, this the massive increase in interest rates that we've seen now in a sustained basis has to come through, and it has to cause some issues. And again, we've talked before about the sort of wall of refinancing in corporate bond markets that's coming through next year. You can't go from rates being sort of 0.25% to 5.25% without it causing issues at some point.